Hi everyone, my name's Pauline. I'm one of the accounting teachers here from TAFE Digital. Today I wanted to go through the FIFO stock card, how to actually record your transactions into the FIFO stock ledger, and then how to do your transactions for all the different dates. So hopefully this might help you with your assessment. So let's look at this example. So we've got Max Hardware Limited uses perpetual inventory method to record their stock of garden rakes. The transaction for the period is set out as follows. So on the 1st of August, they've got an opening balance of 350 units at $15 each. So that's already recorded in this balance here. So 350 at $15 each, times that out gives you 5,250. Then on the 4th of August, we purchased 300 of those units for $13.50 each. So let's record that. So 300 at $13.50 each, times that out, gives you 4,050. So we need to add that to our opening balances. So we end up with 350 each, 350 at $15 each, and 300 at $13.50 each. So subtotal the 300 plus 350, and subtotal the total value. So 4,050 plus the 5,250. So the value of our inventory at that point in time after this purchase is 9,300. Then we sold 250 of these units. So you'll notice that we've got $25 here. So when you're actually putting your transactions into the FIFO stock card, we are only looking at cost. So ignore this figure here. That's only there for later on when we do our journals. So on the 8th of August, we've sold 250 at $25 each. So looking at our stock, so we've got 350 at $15 each. That's your first in. So they're the first out. So of the 250 that we've just sold, yeah, that means we've got, of the 350, we've sold 250 of those. So that means we've got a balance of 100 of those at $15 each, and then we've still got 300 at $13.50 each. So we'll carry that down, and then we need to subtotal the units with the total cost. Okay. So this 100, I'll just reinforce, is the 350 that we had in stock, the first in, first out, minus off the 250, leaves us 100 at 15 each, and then we bring down the remainder of 300 at $13.50 each. Okay, so that's our sale of 250. Then on the 11th of August, we've got a purchase return from the 4th of August of 70. Okay, so let's record that. So purchase returns, we're going to record over here under the purchases column. And you just put in a minus quantity for your purchase returns. So it will be minus 70. And because it tells us what it relates to, the 4th of August, so that was $13.50. So they come back in at $13.50 each. Okay, so when you're doing your subtotals, we've still got 100 at 15 each, plus 300 plus the 70, which gives us 370 at $13.50 each. Sorry, purchase returns. Oh no, we've purchased. Okay, purchase return. Okay, sorry, purchase returns means we've actually returned it back to the supplier. So therefore, we have 300 less our 70 gives us 230 left at $13.50 each, which is valued at $3,105. And remember, with FIFO, you always subtotal your unit cost and the total cost. Okay, so that's the purchase returns for 70. On the 18th of August, we've sold 210. So remember, I'm going to highlight this. So on the 18th of August, let's go down here. We've sold, so of those 210, we've got 100 at $15 each, and then the remainder will be at $13.50 each. So let's record that. So we've got 100 at 15 each, and there's 210. So 210 minus 100 is 110 left, and that's going to be at the 13.50 each. Okay, so let's calculate our cumulative balances. So 100 at 15 each minus the 100 that we've just sold gives us 0 at $15 each. And we then have the 230 at 13.50 each minus 110. So 230 minus 110 gives you 120 at 13.50 each. So it is valued at 120, 13.50 each is 1,620. So subtotal those amounts, and that's our balance after the sale on the 18th. Then on the 20th of August, we've got a sales return from the 18th. Okay, so let's record that. So sales returns, as you would know, sales returns get recorded under the cost of goods sold part, and it's just with a negative figure. Okay, so it's a minus 60, and because we've returned it based on the 18th was based on the 13.50 each, they've told us. So let's so therefore our total values would be the 120 plus the sales return of 60. So we've got 180 at 13.50 each is 2,430. Okay. Then we purchased 190 at $13.20 each. So let's record that. Okay. So on the 25th, 190, $13.20 each is 2,508, and we need to add it to our current inventory. So we've got the 180 at 13.50 each plus the 19 at $13.20 each, and then subtotal just those two amounts, the 180 plus the 90, and then subtotal just the 2430 plus the 2508. I've made the balances bold for each day just to make it a little bit easier to understand. Okay, so we've done all of these transactions up to this point, and then on the 31st of August, we've had a stock on hand of 400. But when you can see, we actually have a balance of 370. So that means we've found another 30. So we need to do a stock variance. So on stock take, you always adjust it in the cost of goods sold figure. And what we're going to do, because we've got 370, we haven't sold, like it's like a, because they were adding to the inventory, it has to be a minus 30 because we want to bring it back in. It's not a sale at 13.50 each. So you bring across the 180 plus the 30 gives you 210 at 13.50 each, gives you that subtotal, and then you've still got the 190 units there at 13.20 each. Find the subtotal. Okay, so let's subtotal the quantity, and that should add up to what your stock tank count was. In this case, it was 400, and then subtotal your value. So that's how you do the transactions using the FIFO, first in, first out. Okay, now let's look at how we record the journals for the different transactions. Okay, so on the 4th of August, we've purchased 300 units at $4,050. The way you do your journal, you're going to debit your inventory control for the cost, which is $4,050. You debit GST paid for the GST component, which is 10% of that figure, and then accounts payable if we've purchased on credit. So accounts payable control, and it's a total of those two figures, your inventory control plus your GST. So 4,455. Remember, each of the journal, you need to have a narration, so purchase on credit on the 4th of August. Okay, next. Let's do the journal for the cash sale that we've done on the 8th of August, this one here, okay? So looking at this, the journal is going to be, let me just record this, because you can see you first need to look at your transactions for the 8th of August. They sold it at $25 each. So when you're doing your journal, the sales is going to be your quantity, the 250, times the 25 each gives you your sales figure. Then you calculate your GST on top of that, and then add those two figures together to get your bank figure. So you debit your bank for the 6875, credit sales for the 6250, and credit GST collected for 625. So remember, whenever we sell inventory, you've also got a cost component that you need to do a journal for. So the cost for this sale is $3,750. So remember, going back to your prior studies, you need to debit your cost of goods sold for the cost for 3750 and credit your inventory for 3750. So that's the cost of the sale for this transaction. Now, the next one that we've got is the purchase return. So we've got a purchase return on the 11th of August. We're going to do the journal for this one. So this is a purchase return. So the journal is going to be, okay, so looking at the cost. So remember, this is your purchase on credit. So it's going to be a reversal of this journal, okay, when you do a purchase return. So instead of crediting accounts payable, you're going to debit accounts payable. Your inventory control, which is the figure here, for 945, we're actually going to credit the inventory control instead of debiting when we purchase. So credit inventory control for the cost, credit the GST pay for the cost, and debit accounts payable control for the sum of the inventory plus your GST. Okay, so that's your purchase return. Okay, so the next I'll do a cash sale for this cash sale journal here. So let's do the journal for that. So remember, when we whenever we do a cash sale, the inventory, the journal would be debit your bank, credit your sales, and credit GST collected. So the figure that we need to sell it for, remember back up here, what do we sell it for? For $25 each. So this is where the sale price comes into play. So 25 times your 210 gives you your sales figure. So credit sales for that figure, the 5250. Credit the GST on top of that. So 10% of that figure is GST, and debit your bank, which is the sum of your sales plus your GST. So that is the journal for the cash sales. But remember, for every sale, you have to adjust your cost of goods sold. So the journal, looking up here at that cost of sale, the cost we worked out to be $1,500 plus the 1450. Okay, so in your journal here, you're going to debit the amount of $1,500 plus 1450. So debit cost of goods sold for the sum of those two figures, and credit your inventory. See? I put a little note here. The cost of these units per your inventory card is the 1,500 plus the 1485 gives you 2,985. Okay, so you can continue on and keep doing the journals. The last journal I want to show you is the stock take variance. Because we've got a stock gain, the journal would be, okay, debit inventory control for the value, okay, of 405, and credit your cost of goods sold for the 405. If you've got a stock loss, you would debit your cost of goods sold and credit your inventory control. So I hope that helps. If you've got any questions, please give the Accounting Help Desk a call. Thank you. Bye now.